can always look at evaluating. So what I always tell the budding entrepreneurs and startup community is, it is always important to associate with the right bank at the right time. You associate with the next bank, and then when it comes to credit requirement, you come to bank without an history, it becomes difficult for us for evaluation. So that's why this idea of starting this group called as New Economy Group, where we onboard clients as a New Economy group client, and we give them the same treatment the way we will treat an Infosys or a Wipro from a corporate banking perspective. We give them entire exposure to the banking infrastructure. And when it comes to the right time, when the transactional flow is good, when the time is right, and if you fit into the evaluation metrics, which is completely separate from the traditional way of evaluating credit, but if you fit into that, we are open to open our books for you. And on the accelerating piece,
so while we are fintech focused, we are open to any technology startup that might have a solution for the bank and would want to consider us to be their one of the first enterprise customers. So what we are primarily looking at is early access to technology and a great team to execute these newer ideas. So it's a 3-month structured mentorship program, so where they get access to domain experts from within the bank, and also we connect them with mentors from the startup community itself. Other than that, they get technology credits. It could be cloud credits or other tech platforms like PFM providers, the APIs from banks in certain cases. They also get a POC with the bank. So it really depends. The scope of the POC is based on the domain in which they are in and the kind of commercialization opportunity that we could explore together. In some cases, they could just become a technology vendor. In some cases, we could go to market together. So it is open. The only expectation that we have is that they already have an MVP. So it's not an early stage accelerator program. No, it is free of cost, and we don't even take any equity unless there is a strategic alignment and the bank decides to invest, and then that is open for conversation, but otherwise we don't take any equity. So the first batch is already ongoing. That started in November and it would close by end of Jan. So we will definitely open the next application in a month or two. In the meantime, you could get in touch with the Thought Factory team, Rashmi Shekhar at accessbank.com or thoughtfactory@accessbank.com. So while the accelerator program is more structured and cohort based, there are other platforms where we actively engage with startups. I spoke about one of them, but on an ongoing basis, we could collaborate.
A question for Accel Bank again. On the line of credit that you talked about, that's more like do you give a venture debt, or is it the traditional one when you want collaterals? Because it's difficult for startups to put up collaterals the traditional banking.
Yeah. So the idea is basically we would think from a venture perspective. We would do the evaluation from a venture perspective. End of the day, it is debt that we are extending, and as long as you have the serviceability on the interest part, it will be purely a debt. We do at certain stages, we have done some venture debt. We don't do venture equity, we have done venture debt, but it's more to do with certain strategic decision. So primarily it is a pure debt.
Thanks.
This question is to all the PE people, PE team who are investing. See, today from morning I can see that everybody is talking on the front of only technology, fintech and everything. But I have some different perspective. If anybody is open to that area, I just wanted to know, because there are certain proposals that we have. What I mean to say is that last 10-15 years, it is only the services economy which has grown in the India, right? Next 10 years, do we think again services economy will drive the economy where everybody is going to prosper or not? That's the first question. Second question is that a lot of jobs are getting lost. The other way of looking at the same thing is that last, the 10 years, the people working in the real estate, they have lost their jobs, okay? And textile has gone down. and then agriculture has come down. And there are certain businesses which are coming under capital intensive. I can look at here that everybody is betting on the human as a resource. Are you really serious on the front of looking, a guy need really a good intensive capital on the manufacturing side, or a good distribution model on the physical, or maybe something coming on the other sides which we have certain proposals. So anybody can comment on that particular part.
Let me try to answer your question. So let me paraphrase based on what I understood. I think what you're trying to say is that most of us VCs who are here, we are predominantly technology-focused investors. Your question is that are we open to doing investments in manufacturing or other allied sectors or not? So see, just because we invest in a technology sector, that does not necessarily mean that there are no opportunities in the manufacturing sector or a real estate sector or whatever it may be. It just so happens that many of us who set up VC funds in India right now, we come from a technology background. So for example, I worked for 15 years in technology companies, in software, and in internet space before I came into the VC space. So that is the business I understand. That is the business I know intrinsically well. And hence, I invest in that kind of companies. And that is the case with most of the VC firms that you see which exist in India today are like that. Having said that, there are several other private equity firms in India which have invested in manufacturing, which have invested in real estate, which have invested in other things. But those tend to be not very, very early stage investments. Those tend to be slightly, what they call the mid-market investments where the company is already set up, some manufacturing is already going on, the product is out there, and it needs to scale up. And that's where the PE firms come in. The stage at which we come in is largely much more of a startup-y thing where it is more at a conceptual stage, more at a product stage, and the go-to-market risk is still, to be completely taken. And that's why, you hear a lot more about technology startups in the news, but that does not mean investment doesn't happen elsewhere. It's a different set of firms.
If I may just add one point, I think the lens we take at Sequoia is not tech versus not. The lens we take is how capital intensive is a business model. So it so happens that a large number of technology companies are supposed to be capital light and should build their businesses, with small amounts of capital you can create large companies. There are other industries which also have similar characteristics. For instance, pharma industry has been one in which not sizably large capital is required to create companies, and we have been investing in a number of pharma companies. Consumer brands we would think are similar, in which with small amounts of capital you can create reasonably large companies. So Sequoia has been investing in those sectors as well. I think there is there are some certain type of businesses which require high amounts of capex. Manufacturing industries would be one of those. Real estate would be another one of those. Power and infrastructure would be one of those. We at Sequoia and perhaps several of the other panel members here, we may not be the right investors for that just because we have different return thresholds and fund characteristics, but there are certainly other types of investors who would also look to invest in those sectors.
I had a question. Do any of you have AIR programs, and what does it take for an entrepreneur with an idea and a half-baked POC to be a part of these programs?
So we at Inventus don't have EIR programs right now, but I don't know if Sequoia or somebody else has it or not.
We don't have any EIR programs either.
We don't have any EIR program.
Was there a broader question?
No, I just wanted to know that if you have any programs, and what does it take on behalf of the entrepreneur to be a part of such a program, and if you were to ever think of such a program, what would you expect from the entrepreneur who has probably an idea or a half-baked POC? So since you do not have them, so you can probably take a second question.
My question is about impact investing. I know that none of you have mentioned about that field as a focus, but considering that there are a number of enterprises in the impact space, and are any of you likely to also look at impact investments now or in the future? And what would the criteria, because the rate of return is lesser than the regular businesses. So, that's my question.
So, we don't do impact investing, but having said that, there are large number of funds which exist within India itself who do impact investing. And the reason for that, the reason why we don't do it is because, as most VC funds, we don't invest our own personal money. We are investing somebody else's money. We have a fiduciary responsibility towards the people from whom we've raised money to follow a certain mandate and deliver certain return thresholds that we have. And it just so happens that a Sequoia or an Inventus, we are on the riskiest side of the investment threshold or the riskiest side of the mandate for these investors, and hence we don't do it. But there are other funds who raise from different sets of investors funds for impact investing, and a significant amount of investments do happen within India in the space itself. So there are the 2-3 names that come at the top of my head is there's a Unitas fund which does impact investing. There's Avishkar fund which does impact investing. There's a fund called Ankur Capital which does impact investing. Omidyar has 2 arms. One does pure capitalistic investments like what we do, and there's another arm within them which does impact investing. There's a Khosla Impact Fund. So there's a whole bunch of them out there.
All right.
I had been part of impact investment earlier, so I will part of Avishkar, which you mentioned. So I will just give you a little bit perspective from my side. First of all, as an entrepreneur, you should think that every investment has an impact. So it's a myth that only impact investing has an impact. The second thing which we are talking about, that impact investing is a patient capital compared to the investment which we are basically doing. So obviously their bar is a little bit low. But any investment can become successful only when it can get investor across all the value chain. So you can get impact investor at the starting stage from Avishkar, Unitas, or maybe Omidyar. But unless you have a totally competitive value proposition, you can't scale up. Just giving example of Sequoia and Avishkar together. So the biggest success story in India in impact investing is microfinance. And microfinance proved itself that there is a business model beyond impact. And Sequoia also invested at some point of time in microfinance. Now they are turning into payment bank, and there's a bigger value proposition. So think impact investing or your impact business from the perspective that, okay, it will have a longer gestation period, but at some point of time, it has to be competitive with the other businesses in the sphere from the return perspective. Maybe distribution or something else might become the second biggest story in impact investing. But that is how an entrepreneur of impact investor should think about it. And as earlier, this name has already been mentioned, so you can target all these funds.
All right.
I'll just
we have
end it
time
with
for just
one
this
statement.
much.
I'll just end it with, so, just at least in my view, there's no entrepreneurship which is anti-social entrepreneurship. At the end of the day, every entrepreneurship creates a huge social impact. Companies which become successful, think of Flipkart today, it has created millions and millions of jobs within the country. So they employ within probably 10 to 20,000 people themselves. Each one of them, their livelihoods have improved. There are millions of sellers within the ecosystem whose all annual incomes have increased thanks to Flipkart, etc. So the ripple down effect on the society is actually enormous and massive. So I wouldn't classify that as antisocial from any lens out there. Pure capitalistic investment, but it is, it has a social impact. So I tend not to classify social impact versus non-social entrepreneurship, just like how he said.
Excuse me, sorry to intervene.
We can take that offline.
Let's take it offline over dinner, please. Thanks a lot, all of you.